If you have less than 10K in your trading account, I'm going to show you how to grow that to well over 100K. We're going to go into the differences between a $100 account, a $1,000 account, a 10K account, and a 100K account, and how those trade differently. Before we jump into it, I just wanted to remind you guys that there's a big red subscribe button right there that's going to give you access to the most alpha Forex training videos available as soon as they come out. Alright, class is in session, time to learn. So the big question today is, how do we trade with $100 versus $1,000 versus 10K and versus 100K? I'm going to show you the common mistakes that these traders will make with the different account balances, and I'm going to show you the differences on how you actually want to perform. And there are some slight differences actually. You'll be surprised, so make sure you watch that whole video, and if you do want to skip ahead to your particular account size, I'm going to put the times in the description below so that you can jump ahead to, say, you know, if you don't care about the $100 account because you already have 10K, then go ahead, jump ahead in the comments below. So $100, you've got your work set out for you. If you actually plan to flip your account to 100K, which I did say in the title, in the intro of this video rather, that's going to be near impossible, and you're not going to do it anytime soon. Let me be honest with you now. So the biggest issue I see with trading $100 is it's very easy to be risking way too much. You're easily going to blow your account, even with the minimum contract size. Say you bet 0.01 lots on a trade, and you let that go for a little bit, it's going to make you lose $10, $20. That's very common. That's 10 or 20% of your trading account. So you do that a couple times and you're going to blow your entire account, right? And it's going to take you a lot longer to rekindle these losses. However, I will say there is one method that you can use trading with $100 that, under my rules that I've set for myself and other traders tend to follow too, you can actually trade with a low risk, and that is scalping. It is very important that you practice proper risk management, no matter what the account size is. And I can make another video going over proper risk management in more detail later on. But the basic rules that I teach is that you're going to want to risk 2% per trade of your total account size. And this doesn't mean you have $100,000, for example, you're going to bet one lot every single time because one lot is worth $100,000. What it means is that if you lose, you will lose 2% of your account. This means if you have $1,000 and you lose 2% of your account, you're going to lose $20. So we need to find a formula that's going to be able to make us lose $20 per trade no matter what. Doesn't matter how much you're going to win, doesn't matter what pair it is, doesn't matter anything like this. You lose $20 per loss. That's final. The reason I follow such strict rules with the 2% loss, and no matter what, is because this does not allow me to think. I want to act like a robot in a sense, right? I do not want any emotional control over my trades no matter what. So it doesn't matter if I have a good feeling about the pair, it doesn't matter if the news is coming out, it doesn't matter if multiple time frames are lining up, anything. I want to always be consistent. Consistent actions equal consistent results. Using this method, we're actually going to have to calculate how far away our stop loss is as a percentage. And for all you no stop loss traders, click away now. You're going to need a stop loss in order to trade my methods. The formula is position size equals the total account size times how much you want to risk. In our case, we're risking 2%, and then divided by the distance to the stop loss as a percentage. So what does this mean? This means if we have a $1,000 account, for example, and we want to risk 2% of our account, and the distance to the stop loss is, say, 0.5%, that's going to give us a total contract size of $4,000 US dollars. Then we need to convert that to lots by dividing by $100,000 because that's what one lot is worth, and that gives us 0.04 lots, and that is our bet size, and that will make us lose $20 if we are wrong. A 0.5% stop loss is very common if you're trading on the 1 hour candlesticks, for example. So to put that in perspective, if we're talking about a $100 account again, and this is why I'm saying it's near impossible to trade on higher time frames with a small account, is if we do that same calculation, so $100 times 2, $200 divided by 0.5, it's going to give us a tenth of that. So it's not even going to be 0.01 lot, which is our minimum bet size. So our risk is actually going to be double what we want. On top of that, you're only going to have one order, so you can only take profit once. Some people like to take profit along the way. I will teach some methods where you can take profit along the way. Flip side of things, look at the 5 minute. I often see trades that are a distance of 0.1% away. $100 times 2 divided by 0.1, that's going to give us 0.02 lots. That's going to allow us to take one profit. It's going to allow us to take one final profit. So we're actually going to be able to trade properly. Woohoo! How do we trade small accounts then? We trade on the smaller time frames and we scalp our trades so that we can actually bet more as a position. The only other thing I would like to add here is if you do have under $1,000, this is the one and only time that I recommend breaking my risk 2% maximum rule. And I will say you can bring that up to an absolute maximum of 5%. Just because $100 is very easy to accumulate, you can probably make that in 1 day of work. So it's not a big deal. But once we're getting over $1,000, that's when some people start to struggle with money. That's when you actually want to practice the real rules of trading. So I bet you found that pretty useful, eh? Who would have thought this guy might actually have good advice? I'm going to keep dropping these wizardry bombs of knowledge on you as long as you click that like button below. $1,000. This is probably where most of you guys are sitting around. You keep dumping money into your accounts, over leveraging. You might have a good strategy that works most of the time, but because you're betting too much and you're not following that secret formula that I just gave you, that you could skip back to if you missed it, you're losing your accounts. You're slowly going broke, and you're telling yourself, I will start using proper risk management once I get enough money. That's garbage. Start doing it at 1,000. This is exactly the mentality I want to get out of your head. $1,000 accounts are very powerful once you start compounding your money. You're probably working a full-time job where you can keep piling on more money, so you're going to be able to get to 10K in no time if you're trading properly and you keep adding to your account. What I'm saying is $1,000 accounts are the best place to actually start learning how to trade properly. You're not risking too much money when you are losing, and you do have the ability to trade using proper risk management. You're able to trade any style you want. So what you're going to have to do is you're going to have to start thinking of strategies. You're going to have to start listening to other people. You're going to start having to follow the strategies that I start teaching you in following videos, and you're going to actually have to put them to the test and do back testing and live data collection testing. So you're really just trying to create as much data as you can so that you can use that data for when you do get into the bigger numbers, because then you will know exactly how much you will gain and lose over a long period of time. I can't stress how important this step is. Let me kind of sum that up for you. This is what you're going to do. You're going to trade with that $1,000 account, and from your job, you're going to start investing 10 or 20% of your income into a side account. Do not trade with this money until you've created that data collection of at least 30 to 50 trades that are showing that the strategy that you've created is profitable. Alright, now you're playing with the big boys. You got 10K in your account, you've built that up from saving up, and you do have a proven method. The 10K milestone is going to mean that you're going to have to start practicing your discipline and making sure it's very strict, because you do already know that method that is going to get you up to 10K. The actual trading itself is basically the exact same, because you're not getting to high enough numbers where it's going to change anything itself. But this is where you're basically going to have to lock in your mindset. You're going to have to be in full control over your emotions, even when something is going wrong in your life, or don't trade when something is going wrong in your life. To say it simply, you're going to trade the exact same as if you did with a $1,000 account. The bigger money does not mean you will trade any differently here. You just think that you will be trading differently. Congratulations, you've made it to every trader's goal. Now this is actually the most amount of money that I've seen in a trading account, and what I'm going to be able to say about it is you're actually going to be able to work full-time as a trader with this amount of money. Below this, it's a little bit iffy, and you do need to worry about, if you're going to have a good or a bad month. With this amount of money, you know that you can live off of just the earnings of your trading. There's a few differences once you get to this level where you are living full-time off of your earnings in trading. The first is simply that a larger portion of your profits are going to be taken out as profits. Before this, you've just been accumulating your account in hopes that you would get to this point. So now that you're at this point, you're going to be taking out your money, and you could be investing that in other businesses, real estate, or long-term investments such as the stock market, Bitcoin, BitConnect, whatever. From the trading side of things, there is two major differences that you will see. The one is that you can create walls in a sense. So this would be where you place a limit order and then the price can't actually pass that because the smaller traders don't have enough money to fill your order. Mind you, I need to make this clear, this won't work in the Forex market. It will only work in very illiquid pairs or exotic pairs to some degree, and it will work in small cryptocurrencies, for example. You might be able to do something with Bitcoin. Small illiquid markets, you're going to be able to make these walls. Another thing to note is in these same markets where there's not much volume, you're going to be able to have something called slippage. This is not good. I shouldn't have worded it that way. Slippage is not good. Slippage is when you place a market order at a certain price. Say it's at $10 right now, and you market enter, and there's not enough orders resting to fill your market order. It's going to bring the price up to 11. So now on the end of your order, you're actually paying 10% more. So 10% slippage is ridiculous. You'll normally see 1-2% slippage, something much smaller than that even. But that's something that the major players do need to worry about. So you're going to have to monitor these. And if you are in an illiquid market and you place a market order, you could screw your account over and then not be able to exit at the same price or anywhere near the same price. To sum that up, playing with big money, you're going to have more options. You're going to be able to play games against other big money if you really want to, and you're going to be able to control the market a little bit more. That being said, there's more difficult things to understand also. You can't be so aggressive with your orders. You have to be more careful. Now then, I've got a bonus one for you. This is how the banks trade. I don't trade this way. I don't have the money. This is when you're getting to well over $100 million. This is when you can basically control any market you want in a sense. You can put walls places so that it takes longer for retail and other banks to fill the orders, And the way that you're going to be trading this way, which you won't be, but it's important that you understand this. The way that you can trade with this amount of money is the biggest issue is getting your orders filled. So you're going to have to be very creative, and you're going to have to put your orders in a sense behind major levels, or leave resting orders for years and months. And then this ultimately kind of creates the same effect where you'll see a level be hit, it'll bounce off, it'll come back, it'll go just past that level and hit the rest of the orders, fill those, and then bounce up again. This is something that we like to call stop hunts, right? And that's when basically somebody puts their stop loss behind a level, thinking that if it goes past that level, price is going to reverse. It goes just past, wicks back up, and that's basically filling the bank's order. So what they're doing is they're using the liquidity of your stop loss, so the selling of your order, to fill their order. So they're really just taking advantage of your stupidity. If you guys watched this far, I'm sure you actually enjoyed this content, so please hit that subscribe button once again. Another thing that you can do is scroll down into the description. I've added a Discord link. This is just a community where we can chat, things like this. I'm throwing a couple signals up there just whenever I feel like it, but it is not a signals group.